Well, we're just gonna okay. Well, we'll just end that abruptly because I still haven't figured out how to do audio transitions. Welcome to PacaCast. Tonight we have a special thing. It's something near and dear to my heart. It is something that has been discussed, not necessarily in the timeline discourse, but it has been discussed broadly amongst friends and peers and anons alike. And of course, tonight we are talking about the Trump accounts and financial planning for your children. Um, we have a special guest tonight who is he's a near and dear friend to me. He manages millions and millions of my dollars theoretically, and he is what we call in the business a quant. He's a wunderkid. He's a guy that knows things. Uh, Please say hi to my guest, uh, my Pacas Quant. We're gonna call him Quant for the rest of the night. Hi, Quant. How are you doing?
Hey, thanks so much for having me, Mr. Paca.
Of course, of course. So out of the gate, we are going to put some disclosures out there. This is not intended to be financial advice. There is no contract implied, expressed, or otherwise stated that we are providing you with financial advice. This entire stream is a joke. It is hilarious, ha ha, funny times meant for educational purposes in the art form of irony and memes. We are not responsible for your financial decisions. Um, that said, we are going to now put on our clown noses and talk about finances. Quant, have you ever heard of foo?
Of what?
Of the foo?
I have not. Tell me
Hmm.
more.
Well, see, the foo is the financial order of operations, and I'm not surprised you haven't heard of this. This is more of a plebeian issue that people down in the trenches tend to need to worry about. But the financial order of operations is essentially the uh, general kind of guidelines for what you should do with each dollar that you earn after taxes, obviously, because no one wants to go to tax jail. Um, what we are covering tonight is between 6 and 7. So if you are in a situation where you can't afford your medical bills and your deductibles, you're not maxing out your employer matched funds. If you have any sort of 401k or pension match type of thing, if you have high interest debt like credit card debt that you can't get out from under, you don't have emergency reserves. We are not necessarily talking about things that you should be concerned about in many respects. Now, there's one aspect that I think is universal, but um, the big thing for our guys is we need you guys to be financially healthy, and so that means not being under crushing debt, making sure that you're taking steps to maximize your income, minimize your expenses, and steward your household well. For the guys, and if you're one of the ladies doing the books for the house, you should be serving your husband and your partner well to ensure the household finances are in good order. Once you're at that position, we needed to talk about the main topic tonight, which is financial planning for kids. So we are. I'm going to get. Oh, nope, not the sponsors, not my fake sponsors. We're going to get into Trump accounts and the modern child planning toolkit. And there's a couple of different things that are part of this discussion. I know Quant is more is passionate and knowledgeable about some of the custodial models versus the Trump plans. But we're going to talk about the Trump accounts, 529s, UTMAs and UGMAs, custodial Roth IRAs, as well as like some other niche planning tactics. And the goal is this is stuff that, like I said, it's all haha funnies, it's jokes, it's meant to be satire and irony. But if you find something interesting, it is a good thing to talk to your local professional, your accountant, your financial advisor, your CPA, your CFA, your CTFA, whatever, and see if you have ask them questions about this kind of stuff. This is mostly just to spark some interest in the community. You ready to go, Quant?
I'm ready. Let's do it.
All right, I'm going to dive in. You just jump in anytime you see something interesting. Um, uh, Today we're going to talk about the five vehicles, and then we're going to kind of compare the rules, do some projections on, on what the value of these accounts will be over their lifetime, and then we'll kind of talk into some more niche planning techniques. Um, the landscape that we're talking about right now, we have the Trump, which is the Section 53A. The Trump accounts. It's a general purpose retirement head start. So it's not necessarily for education or for a specific purpose, other than you know, uh, Quant has a theory that it's partly to alleviate some of the strain on Social Security, whether or not it's going to be there going forward over the next 60 to 70 years. If we have something, if kids have a Roth IRA or a traditional IRA over the course of their entire life, even if it's funded with something nominal, um, over that time, it might be enough to help kind of alleviate some of the burden on the Social Security trust in general. Um, the contribution limits are $5,000 per year, and that is per child per account. $5,000 plus if your child was born between 2025, 2024, 2024, and 2028, you qualify for a $1,000 pilot's deposit into that account, which will be contributed by the federal government into that account wherever it gets set up. And then once
Well,
the
and
good,
I think before we get really into the weeds on how each of these accounts work, is talk about just the core purpose of each one and maybe some major pros and cons that people might not be aware of.
yeah, sure,
So, just to walk through some of these, the Trump account, like you mentioned, generally it's kind of a grab bag account for retirement savings or maybe other needs in the future. 529 plans, that's generally going to be for education. UTMAs are going to be for basically anything. The Coverdale is basically an inferior 529 plan, and then there's the custodial Roth. Now, I would like to break these into two major categories. So, one category is, do I keep control of this account or does it go to my kid in the future? Because for some people, that's an important consideration on who actually holds the cards. And my understanding is with Trump accounts, that those will go into the kid's name at 18 and they'll have control. Same thing with UTMAs, they're different ages for different states. And then the custodial Roth as well eventually will become theirs. The only one where the parent really maintains control in the long run is the 529 plan. And so I think that's an important consideration for some families.
yeah. I'll get into more detail about the 529 plan, but later on, you basically have two options. You roll the 529 plan over into something for another child. Perhaps you have like younger children, and this is your firstborn. So once they're done with their education, you can roll those funds into a 529 plan for subsequent children, and use it for educational spending there. Or there's ways that you can exit out of it for the child, but it's subject to a bunch of different nonsense. Um, and then yeah, the big thing, one of the themes that we're gonna probably touch on a lot is as a parent, when these kids, it's great to set up the plan. It's great to have these vehicles planned out years and years ahead of time. They have significant growth. But if your kid doesn't know what they're doing and they turn 18 and they end up with essentially an IRA or a custody account that's got a decent amount of life money in it, or at a minimum like a life changing amount of money for a college student to blow on beer and cigarettes. Um, you know, there's ways that they can really screw up their plan, because like Quant said, they're going to have control ultimately. So there's going to be some significant parental involvement in training your kids to be good stewards of these nest eggs that you're setting aside. Um,
Yeah, and I would say that's probably first and foremost before you even think about these vehicles, you need to be thinking about, how do I raise financially literate children, teenagers, and adults?
Yeah, and if you're in, I think there's a lot of confusion from guys on their own financial literacy and their own financial situation. And if you're one of the guys that has the humility to say like, I don't know what I'm doing with any of this stuff. If you have trouble looking at your car loan and understanding what the terms mean, or what the different aspects of a mortgage and PMI and that sort of thing. Um, find someone in your church. Yeah, I do work for like diaconate ministries with financial counseling. I'm sure there's guys that you can trust, that you can be candid about your finances, and utilize those resources for yourself, as well as introducing your children to people like that and having them join in on the conversation early. There's the weird Anglo aversion to discussing money with your kids, and that exists, that perpetuates like across all class levels. Rich people have the same kind of weirdness about talking to about money with their kids. um, but this is part of being a good steward of what you have and what you're giving to your kids, as in the form of like an inheritance, and with financial planning for their lives. It's really important that they have buy-in, and feel like they're involved in the process and have a full understanding of how it all works. um, so we're going to get into this in great detail. The only one we're not probably going to talk about much is the covered out, because like Quan said, it's not great. There's some interesting planning for K through 12, especially for homeschoolers, where you can effectively put some pre-tax dollars away for specifically for purchasing homeschool materials. But outside of that, we're just going to focus on the stuff that actually generates some growth and opportunities for your child. So the first one is the Trump account. Um, and just the 10,000-foot overview. This was created by the One Big Beautiful Bill Act, signed into law July 4th, 2025. Um, and there's been some substantive guidance on how this is all going to work. It takes a while for the regulators to catch up with what Congress and the White House are doing. So there's been significant back and forth about how the accounts are going to be opened, who's going to have custody of these accounts, like where is the bank going to be that holds all this money, what can you invest in. So with a Trump account, you should basically just think of it as a special purpose IRA. It is simply a traditional IRA established for a U.S. citizen child under the age of 18 that has a valid social security number. And now that July 4th, 26 has passed, these are effectively open. You can begin contributing to these and opening these accounts. And I know many people have been working on that this week. The single most important, um, uh, okay. So as an authorized individual, which is going to be the parent or legal guardian, opens the account either on the website. You can go to trumpaccounts.gov, and I don't have a printout or any of that, for this presentation, but you just go to trumpaccounts.gov. It's the website is specifically written for the lowest common denominator, so you should have no problems navigating it, being brilliant people that you are. Or you can file form 55, 45, 47 with the IRS. I don't know why you would ever file an IRS form if you could just do it online. Um, but the key thing is the election has to be made before January 1st of the year the child turns 18. So even if you have a 16 or a 17-year-old that is alive this year, you could still set up, a Trump account for them. You're not going to get the seed money, but you can still set it up. Um, and then there is this period called the growth period. And it begins when the account is established. So whenever you fill out those forms and you get a confirmation letter back or an email back, it says like your account is ready to fund. That is the establishment date, the inception date of the account, and then the growth period is from the inception date of the account to the December 31st of the child's 17th birthday. So the year they turn 17 on December 31st, that is the growth period. Which and then after the growth period, funds can become freely accessible. So there's a lockup provision in this. You are contributing money. It is not something that you can take money out of, barring like special exigent circumstances, if that makes sense. Um, so the the annual aggregate contribution limit, $5,000 for all contributors combined, indexed in $100 increments after 2027. We'll see. I don't know how much that all matters, but there is an indexing, so um, you can increase contributions after 2027. Um, Parents, guardians, and other individuals, anybody, can contribute to a 529 plan, or sorry, a Trump account. It does not matter where the money comes from. Anybody can put money in. However, it's not a tax deduction. So this is all post-tax money, that you're not gonna get any sort of discount or rebate on your income taxes, by contributing to this. Um, and then children born between 2025 and 2028 also qualify for a one-time $1,000 seed federal deposit. So if you have a kid that was born last year, this year, next year, or 2028, you qualify for that $1,000 one-time deposit. And that is probably the most powerful aspect of this entire planning tool. Is uh, You don't even need to put money in yourself. If you have a newborn child, you will qualify for that $1,000. Um, and the other interesting thing is there's been an increasing amount of employers, Dell, JP Morgan Chase, Russell, several others, have come forward and said that they will be contributing to Trump accounts on behalf of their employees. So you might want to check with your employer and your HR department, your benefits coordinator, whatever, and see if that's on the within the plan for the next fiscal year for these companies. A lot of the fiscal planning is done over the summer with the fiscal year starting in September. So if it's something that they're planning on doing or working on, you might want to get a jump on opening the account and getting it ready to fund. Employers can contribute up to $2,500, $2,500 per employee per year. That's not per child. So if you have one child, your employer can contribute up to $2,500 for that child. If you have two, it'll be 1,250 per child, or however you want to allocate it. If you want one child to get more because they're younger, one child to get less, doesn't matter. But that $2,500, however it gets divided up among your children, if you have this employee benefit, it counts towards the $5,000 cap. So if your employer gives you $2,500 for your Trump account that you opened for your kid, you only have $2,500 less left that you or your parents or anybody can contribute to that child for the year. So the $5,000 cap for the year, it's a hard line, indexed for inflation after 2027. And there's also, I guess, some seed money that is presently available. The Dell Family Foundation. If you live in lower income zip codes, there's $250 per eligible child. Not exactly sure what the eligibility requirements are or what constitutes a lower income zip code. If there's some sort of
So it's
demographic.
it's actually for it's zip codes that have a median income of 150,000 or less, which I don't know how they're calculating that, but that's still probably fairly wealthy. So most areas are going to qualify for this.
Interesting. So it might be something that definitely is worth looking into. Any chance you can get free money, get the free money. It's probably just you have to fill out a form and submit something.
And I would say don't be lazy. Might take you an hour, maybe 2 hours to do it. That's $1,000 an hour. So do it for your kids.
Yeah, yeah. I mean, this is all very low effort stuff. And the one thing that the Trump account has for it above the others is that there's zero barrier to entry. It's a website. You put in the information, you're done. They'll send you wire instructions. You put money in, and then you're done. You can probably set up like some sort of auto remittance from your bank account where like $25 a paycheck goes in or something. It All it takes is a little bit of effort on the front end. From a planning perspective, there's probably a lot of different ways we can go based on your specific situation. But in terms of ease of use, this one is fantastic. Um, so we talked about the contribution limits, the employer thing. Uh, if you accidentally, so if you say you have a automatic transfer from your checking account to your child's Trump account, and you accidentally overfund, you contribute over $5,000, there is an excess contribution penalty of 6% excise tax per year until the excess is corrected. So there's probably a methodology, talk to your accountants, but there's probably a way to recoup those funds. If you accidentally overfund, you can probably get a refund back. If not, there's penalties. They are very strict about the contribution limits on this. Um, so if you are somewhat savvy, uh, the eligible investments for this fund are different than, say, like a 529. It Each of the custodians that are running the way it's worked, in my understanding, is that the Federal Reserve screened a list of custodians that applied. So Fidelity, J.P. Morgan, Charles Schwab, um, you know, can't think of Merrill Lynch, whatever, and approved the plans that these custodians had written out based on their desire to have these Trump accounts on their books. So these are all placed with U.S. custodians and brokerages, but they are limited to uh, funds, and it's probably going to be proprietary, like exchange traded funds or mutual funds that are uh, tracking just the S&P 500 style broad US company index. So your S&Ps, your Russell 2000s, it has to be a US some sort of uh, you know performance index with only US publicly traded companies. Is that correct, Quant?
Yeah, I mean, I think they'll have something that's like a U.S. total market fund. The regulations are still being released, but generally you're doing some pretty boilerplate basic funds.
Yeah. And, no leverage. You're not going to get your 5X, SDALs or whatever. Um, the annual fees are capped at 10 basis points. So what that means is that the maximum amount of fees that a custodian can charge a Trump account is 0.1% of the balance of that Trump account. So if you have $100,000 in there, they're only allowed to charge, well, shoot, now I can't do the mental math in my head. I'm blanking. 100, is it $100? Oh, this is embarrassing. Quant, you're the math nerd.
You cut out on my end there. What was that last part?
What I'm trying to give an example for what 10 basis points looks like.
On $100, it's like 10 cents a year.
Yeah, on $100,000, it's $10.
Yep,
Okay.
basically free.
Yeah. So there's no fee issues that you need to think about. The way these guys are going to make money is, initially it's just going to be aggregation. There's probably millions and millions of people that are applying for these accounts. So in aggregate, these custodians are going to be making money. And then once the kid turns 18, they turn into a traditional Roth, and they're probably less hamstrung by fees. So these brokerages are playing ball in the short term, to have clients in the long term. Um, and then so distributions and tax treatments. There's no distributions during the growth period except for there's certain qualified rollovers and qualified able rollovers, which are specifically accounts for disabled children. They're tax advantaged accounts where you can use those funds to pay for special needs children, equipment, that sort of thing, or distributions upon um, excess contributions. So if you do accidentally put too much money in, you can take it out, or upon the beneficiary's death, you can it goes back to the beneficiary's guardian. God forbid. Once the growth period ends, so once on January 1st of the child's 18th birthday, uh, once the growth period ends, the account is administered exactly like a traditional IRA. It effectively becomes just a normal IRA account. Ordinary income tax on the taxable portion of the distribution, and a 10% early withdrawal penalty if you take money out before your 59 and a half. except for there's certain exceptions under the IRA, the IRS, disability, qualified first-time home purchase up to $10,000, higher education expenses, and substantially equal periodic payments, etc. So this is a vehicle that you can use for certain higher education expenses and for help with a down payment on a first time home purchase. Anything to add there?
Nope.
And then contributions from individuals are not tax deductible. No non-deductible basis exists. If there is ever if it's recovered tax free under pro rata IRA basis recovery rules. If that sounds like something you'd like to learn more about, ask somebody else. I do not do work. um, so the benefits, there's no earned income requirement. Every single child is eligible. So everyone is eligible if you have a kid that is a U.S. citizen with a social security number. Sorry, crunchy granola moms. If you had like the bathtub birth and did the sob sit thing and refused to, file the paperwork to get your kid a social security card, you don't qualify for this. So it's open to everybody that has a child that's a U.S. citizen with a social security number. You get the seed deposit if your child was born between 2025 and 2028, plus the potential philanthropic seeding, and the employer benefits. Uh, there's ultra low fees. It's effectively free, and it's simple, standardized, federally administered. There's very few decisions anybody has to make until this turns into a traditional IRA. The drawbacks is, if you are more middle class or upper class, and you're looking for something that's a consistent vehicle for larger amounts of money, you are capped at $5,000 a year versus like a 529 or an UTMA. There, it's a single mandated investment style. So if you have assets that are allocated very heavily in the S&P, in other accounts, you can't hedge or do more creative investing in your Trump account. Growth is taxed as ordinary income at exit, like every other IRA. So what that means is as you take money out, so it grows and grows and grows until you either take a qualified withdrawal for homes or college expenses, or you let it sit until you're retired. Every single dollar that you take out of that account is taxed at your marginal tax rate. Which when you're retired, it's probably going to be pretty low, but you never know. And then uh, there's several like regulatory issues that are unclear. Will this continue on past 2028? Will contributions be fully indexed to inflation? It's a new product. Everyone's excited about it. We're not exactly sure how the regulators are going to deal with everything quite yet. Um, but the best fit case in this instance is lower income or middle class families. It's simple, zero effort, federally seeded retirement head start layered on top of other education specific savings. So if you're focusing on this as the bare minimum that you can do for your kid in terms of money put away for them, great. If you're doing this as a supplement to existing education specific savings like a 529, then even better. I guess there's no cost to participate beyond just the time you put in. And at this point, it's just like, why not? Why not do this? Anything else to add on Trump accounts, Pepe?
Yeah, I mean, I think the biggest potential downside is if you are a higher income household is that income, that ordinary income taxation can definitely work against you if you're considering other options like a UTMA, 529, or even Roth, minor Roth contributions. It might not be the best fit for everyone, but get that free $1,000.
Yeah. And we'll talk about it a little bit later, but there are ways to mitigate the taxes as well. If there's long term planning you can do. Again, it's going to come down to whether or not you got your kid to buy into the overall strategy. Um, So 529 plans, these have been around since the 90s. my parents had one for me, and by the time I went to college, I think there was like $2,300 in it. Um, but these are state sponsored programs, state administered programs and plans, and residents are free to use any state's plan, regardless of where they live. Though many states offer state income tax deductions or credit only for contributions to their own like child's plan. So if you work in I don't know, it's like West Coast, right? If you're in California, if you work in California but you live in Las Vegas, because you want lower income taxes personally, um, but California has a 529 where you can contribute to the plan and get a credit back on the the part of your state income tax that's derived from California. You can, even though you're a Nevada resident, you can open up an account in California and still get those benefits. Um, there's no federal contribution limit that exists. This is constrained by something called the gift tax exclusion. And some states have like aggregate account balance cap, which range from like 235,000 to 620,000, depending on the state. But the important thing is that is like the top level of amount of money you can put in as a whole. Um, if you are in a position where you can give uh, thousands and thousands of dollars towards your children and their education funds, or you have parents that are somewhat wealthy and are wanting to do contributions, big contributions to education, um, the the tax free amount that you can gift to a 529 is $19,000 a year, and that's based on what's called the annual gift tax exclusion. And I could probably talk on that for a while, but I don't think it matters for 90% of people that are doing this. If you are if you're wealthy and you want to do gift taxing stuff, talk to your CPA. They will tell you all about the annual gift tax exclusion amount.
Yeah, and I think at the highest level, the real benefit of a 529 plan, if you start it early, it grows tax free. And when you take money out for education, it's also tax free for most states. Not true for California, not true for every state, but that's the primary benefit. So if you put in 50,000, it grows to 100,000, you're not paying taxes on that growth. And the major downside is it's only reserved for education. And there's some other ways to be creative with it, but it's less flexible than some other options.
Yes. Um, so I mean, there's a lot of stuff here, but the two big points I think, like this is a good tool if like grandma is on her deathbed redoing her will and she has a significant amount of money she wants to give to her grandkids. A decent vehicle to do that would be having like a super fund. You can fund up to $190,000 per year or, for as a one-time lump thing, and left alone. It's counted. They allow you to effectively do a gift tax, pro rata gift tax of 5 years worth of contributions at once at a time, and it's treated as a completed gift, which means it will be taken out of grandma's estate and reduce her most likely state but also federal estate tax. Um, the other big thing is the OBBA expanded qualifying K through 12 expenses, and doubled the withdrawal cap to 20,000 starting with 2026 distributions. So that means you can take more money out per year for education expenses per child, but also you can, and I kind of confirm this, but I'd recommend you taking this as a joke and looking it up yourself, proceeding at your caution. But I believe you can do extracurricular programs as well as homeschooling curriculum with the 529 based on the OBBBA as of 2025. So they did expand. It doesn't have to go to private school, or or like a formal college. There are ways that you can utilize this as like a more traditional homeschool family. Um, yeah, qualified higher education expenses too, tuition, any fees, like lab fees or membership fees, that sort of thing, books, supplies, any equipment that you're required to have. So a laptop, room and board, for anyone who's on campus with at least half-time enrollment. Also, it expanded it to postgraduate and post-secondary credentialing expenses. So if you need to do an LSAT prep course because you're taking or sorry, if you are doing like a bar exam prep course, or you're training for like a CFA or Series 7, and you are doing a tutoring course, um, they've expanded the 529 so that you can utilize it for that kind of stuff as well. Um, and
Yeah, and
then, sorry, go ahead.
I would say with these accounts, there's three major pitfalls that you need to be really careful of. So the first one's overfunding. You want to make sure you're not overfunded. So if kids are going to school, use it for the first 1 to 3 years of college. Don't try and save it for the last year. And then make sure you're using it on all eligible expenses like internet, laptops, not just tuition. And then the second one is every state has different rules on how they tax it, the tax breaks, if you have to use their plan, if you don't have to use their plan to benefit. These are all things that you want to look into before you do it. The third one is really making sure it's invested appropriately. Most of these have like a basic target date option that says, hey, when your kid goes to school, it's going to be in 2035. They'll adjust the investments based off that. For most people, that's probably the way you want to do it. You want to make sure you get the investment set up correctly when you're funding it.
Yeah. One of the challenges we had was my state, it has a menu effectively of mutual funds, and they're not the most fee conscious mutual funds. The performance is lackluster relative to the market and the benchmarks. So there's definitely like some drawbacks in certain states, which, one of the good things is you can shop around a little bit, to see which state has the most to offer you in terms of state tax benefit as well as investment options. Um, and like Quant said, um, the any earnings on it is taxed. If you withdraw, there's a it's taxed at your marginal rate plus a 10% penalty. So if you're a 20% tax bracket for federal, and you withdraw, you're going to be paying 30% tax on every dollar that you withdraw for non-qualified expenses, so non-educational expenses. Um, there's scholarship offsets, but or death and disability, you can obviously recoup the funds, but those are more complicated. Talk to your CPA. And you can change the beneficiary, like I said. So if you have a child that's, you didn't really need to tap into it as much as you thought, you overfunded the 529, you can, change the beneficiary to another one, and use it for another kid's college funds. Um, so the benefits, like we said, there's no contribution ceiling, and this is one of the tools that can scale. It's a great tool for middle class people all the way up to the uber rich. Um, the It has the best financial aid treatment. So if you're a parent that has ever done like FAFSA paperwork for your kids' college applications, um, a 529 does get a 5.64%, and I'm not sure why why the number is the way it is, but 5.64% of the value of the 529 is considered to be an asset of the child. So it if you're on the line for FAFSA, um, it could cause problems. So that's something you'd want to make sure that you're taking a look at. But relative to other types of accounts like UTMAs, um, the this is a pretty efficient tool for FAFSA applications. The parents retain control indefinitely. So unlike the Trump account or UTMAs, you don't have to worry about them turning 18 and then like raiding the funds to go have a big party or buy a used Toyota Prius. Um, Everything you have control of the account throughout its inception and lifespan. Um, and there is a Roth rollover escape hatch, but it's only $35,000. So if there's funds left over, you don't have any more beneficiaries that have educational expenses. There's kind of a Roth backdoor that you can do to get out of it. You can talk to your accountant about the best way to make that happen if you fall into that bucket. Um,
And I will say this is a little overbaked in the media. They make it sound like you can just move 35K straight to a Roth IRA. And the reality is the account has to have been open for 15 years, and the normal Roth IRA contribution limits apply for that Roth transfer. So if you're someone listening to this and you have a overfunded 529, you can't just move 35K to the Roth IRA.
Yeah. Um, some other drawbacks: it's only educational expenses. If you do anything it's not educational expenses, you will get penalized. Um, the definition of educational expense quote is a little bit broader than it used to be, but it still has to. It's something that you could get in trouble for. Investment menu is limited, like we said. There's a 10% penalty on top of any marginal tax rate on any non-qualified withdrawals, and then state plan quality and fees are really broad. So just make sure you're taking a look at the fine print anytime you open a 529 with a broker, or with your state run program. Um, just look at the fee disclosures and look at the investment options. Um, so families of any income level who are reasonably confident that education is a goal, especially higher education, um, this is a great vehicle for education specifically. It's just one that requires a little bit more, probably significantly more forethought than the Trump account. And then Quant is my resident expert on UTMAs and UGMAs. So do you want me to like give the overview and you can dive into it, or how do you want to do this?
Yeah, I'll do the overview. I mean, the way you want to think about the UTMA is it's essentially like a minor investment account. If you're familiar with like a taxable investment account, brokerage account is another way it's referred to. The short answer is you put 10,000 in, it grows to 11,000. You only pay taxes on the gains when you actually sell those investments. And you also pay taxes on dividends along the way and interest. So it does require a little bit more financial knowledge on tax preparation, understanding when to buy and sell investments. And then the other important thing to consider with these accounts is something called kiddie tax. And basically, the government says we're not going to tax $1,350. The next 1,350 is at 10%. So basically, they're giving you a fair amount of dividends and interest tax free. So until accounts start to get around 100,000, you're probably not paying much in taxes, if any. So it really is a good way to save, and it's extremely flexible because you can use it for anything. So let's say a kid needs a car, or maybe they want to start a business in the future. It's not locked up like the 529 plan. It can be used for anything that they want. But there's some other downsides there. But before I jump into those, anything you want to cover there, Paca?
Um, no, I mean the highlights are it's going to follow the similar funding rules. Funding an UPMA, you really only need to worry about it um, if you're the amount you're funding is going to brush up against federal gift tax, which again is $19,000 per grantor, per beneficiary per year. So that probably not something most people have to be concerned about. And then UPMAs are considered uh, they're considered the child's asset when doing college FAFSA applications. the assessment rate is 20%. So if you have $100,000 in an UTMA, $20,000 of that will be considered the child's reportable wealth asset under the FAFSA asset tests.
Yeah, and I will say the people that typically utilize these accounts are probably not going to be eligible for FAFSA. But that's not true for everyone.
So just to kind of the kiddie tax thing, it's an interesting concept most people don't really encounter. Um, but if you have a minor, um, you know, the this was something enacted in like 1986 specifically to prevent income shifting into a child's lower bracket. So if you had like a sizable retirement account, you could just retitle that in the name of your kid. It's a kiddie tax. They're a minor. It's non-earned income. So we're only going to get 10%. Of tax on the ordinary income within these accounts. 1986, the Reagan admin put the kibosh on that. It was probably not Reagan, but the guy before him. So the kiddie tax only, yeah, the child has $1,350 of standard deduction that wipes out that income tax. Then the next $1,350 up to $2,700 total is taxed at the child's rate. So that's typically 10%. If there's income over $2,700, everything over that amount is taxed to the contributing parent's marginal ordinary or long-term capital gains rate. And it's whoever gave the most amount of money to the UTMA, it's whatever tax rate they're at. So that's something to consider, mostly for high net worth people, but it's Quant, what do you think?
Yeah, I mean, these accounts have a lot more nuance and probably are the most difficult account out of all child savings accounts. But it's also very effective because it have how flexible it is, but also once this account becomes their own in the future, if they're still relatively low income earners, they can maybe sell a portion of the account and not recognize any capital gains once it's in their name, or at 0%, or maybe just 15% plus whatever their state rate is. And it's very flexible, so they can use it to buy a home, maybe start a business. And I think that's the most attractive element because we really don't know what college is going to look like in 10, 20 years. Maybe the college system goes away and you're worried about that. That's where I think the UTMA is going to be a lot more attractive if the US education system in its current format goes away.
Yeah, I mean, if we replace college with like AI college, right, where you can still, as long as you're participating and talking to the mechanical demiurge, and like you're in the live stream chat, um, will you be able to use your 529 for those types of educational expenses? Um, so yeah, the benefits are the pretty much the flexibility and the openness it is, and the like Quant was saying, the capital gains. Um, so if you let assets appreciate for say 18 years, and there's significant capital gains in there, you can effectively do some maneuvering to wipe out a considerable portion of the tax that would otherwise be assessed on those capital gains. Um, it's irrevocable, so anything that's given to this UTMA is the child's as of their 18th birthday. You can't get it back. It's the worst FAFSA treatment, but uh, and then um, this is another one where unconditional control passes to the child at the age of majority. So it's another one where you have to get your kids involved in the planning process before they become adults, because otherwise there's nothing to stop them from just taking the money and running. So families who want flexibility for a mature, trustworthy beneficiary um, is probably the best case for UTMAs and UGMAs, or if you have more complicated tax and investment needs.
It varies state by state, that age of majority.
Yeah, it's 18
That's
to
important to know.
24. I
I
think
think the
Vermont.
common theme with all of these accounts is you need to be spending time to get financially educated.
Yeah.
if you commit maybe 40 hours over the course of 6 months, maybe 50, you can basically make your family hundreds of thousands of dollars in the long run from tax savings, smart investment growth. But it's certainly a learning curve up front. But if you look at the amount of value you'll get compared to the time you invest, it's a dramatic difference between your kids being middle class, behind the pack, or really the top 20%.
Yeah, for sure. Um, yeah, and, I would encourage if this was a requested stream, um, and something that I consider myself somewhat knowledgeable in. If there's words that you don't know or a concept that you're not familiar with, um, watch the stream back and either Google it or ask your financial advisor, or talk to someone you trust about it. Um, this stuff it's involved, but it's not necessarily all that complicated. There's, you just kind of have to understand the vocabulary first, and like why things are the way they are, and then you can have a better understanding of exactly how they work. And knowing how the system works is how you're able to maximize your advantage within that system. Because we have to live under the regime as it is. None of us are making tax law, but a little bit of knowledge is the difference between your kids, like Quan said, you know being able to afford the top tier school, to become the next generation of elite, versus having to go to state school for 3 years and maybe transfer in to like a tier two if they get lucky. Um, it doesn't require all that much effort. The last vehicle we're going to talk about in depth is the custodial Roth IRA. So the Roth IRA for children, um, and an ordinary Roth IRA. Google that if you don't know what the difference between a Roth and a traditional IRA. Um, Traditional IRA is all pre-tax money; it's tax deferred. Roth IRA is post-tax money, and so your growth is not taxed. So in a stock market where red line always goes up, Roth is going to be more powerful. Um, and regardless of how pessimistic and black pilled we can be about the stock market, our usury system, and all that other stuff, um, none of it really matters in light of like the past 100+ years of the stock market existing. Like it's gone up and down, but it's primarily gone up. A lot of that is just inflation, whatever. Uh, so the difference in this type of Roth account is that a parent or other adult acts as the custodian until the child reaches the age of majority. So again, either between 18 and 24, the child does take ownership of this account. Until then, a parent or whoever is setting up the account is the custodian. And it's the only vehicle in this comparison that requires the child to have their own earned income. So, what that means is that your child has to have W 2 or self employment income from activities like babysitting, lawn care, lifeguarding, tutoring, family business wages. When I was a kid, I was a waiter at a nursing home. And then after that, I worked at a marina, or like renting boats and stuff. And I pretty much worked every summer since I was 14. And because of that, I was allowed to contribute to a Roth IRA that my mom set up. And by the time I was in college, there was, a decent little 5-figure nest egg in that Roth IRA that I squandered subsequently, because my parents didn't talk to me about money. But there isn't a minimum age. I mean, if a child has earned income, you're either qualifying for some sort of family business exception, or the child is probably between 14 or 15 when they start. So it does cause, there's less of a growth horizon before the kid gets to 18. Um, and then, kind of the more granular rules on this. Uh, Only minors with documented earned income, so they have to be reporting some income to the IRS, qualify for a child Roth. The contribution limits are the lesser of $7,500, which is the standard Roth contribution limit, or $100,000, or sorry, 100% of the child's earned income for the year. So if your kid only earns 7,000, you can only contribute 7,000 to that Roth. If they earned 10,000, you can only contribute 7,500 to that Roth. Go ahead, Quant.
Yeah, and then I think a common misconception is people go, well, I don't want to report the income from babysitting because I'm going to get taxed on it. That's a fair concern. You still have to do self-employment taxes typically. You're not really going to pay income tax because their income's not enough to generate a tax bill. And getting that tax-free growth that early on is going to take precedent over that self-employment tax in the long run. Now, it's never fun to pay taxes, but maybe it's a good lesson for kids. And then you're going to get another 5, 10, 20 years of tax-free growth by doing that.
Yeah. Um, Contributions from a Roth, not earnings, but or capital appreciation, but any contribution may be withdrawn at any time for any reason, tax and penalty free, because you've already paid tax on the money that went into the Roth. Um, and then you can qualified earnings withdrawal. So it's penalty free if the account is 5 years old and you're in retirement age. You can take out penalty free for a first time home purchase, up to $10,000 per lifetime. So a decent down payment. Disability, death, and other IRA exceptions avoid the 10% penalty. Um, and then it converts to, once the child is between 18 and 25, depending on the state, it becomes the child's Roth IRA on them for themselves. Whoever the broker custodian that is managing it is going to reach out to the kid and say, "Hey, here's all this money for you," and you have to, as a parent, be responsible for teaching them what to do with the money. Um, so the benefits, there's decades of extra tax-free compounding growth, and this is the most powerful part of a Roth is the you know the the not being taxed on growth is huge, because effectively, if you're starting young, this account's going to sit there for a long time. And if it sits there for a long time, there's ostensibly going to be significant amounts of growth if it's managed decently well. Um, the zero impact on financial aid eligibility, it doesn't even include in the FAFSA stuff, because it is a retirement account. Um, Again, this is not an education vehicle. This is specifically for retirement. This is mostly what we're comparing like the Trump account to. The UTMAs and the 529s and that sort of thing. They're a little more flexible in what you can use the funds for. The drawbacks. So this again, your child has to have documented income. So if your kids, yeah, if your kid's like on Xbox playing the Fortnite or whatever the kids are doing these days, and not doesn't have a job or isn't making money anywhere, yeah, he or she can't contribute to a Roth. Um, Contribution ceiling is 7,500, which is fine, but whatever. It's a little small. Um, Earnings are effectively locked until retirement, absent qualifying exception like your first time home purchase. And that's really the only exception, unless the catastrophic accident or something like that. But really the only time you're going to be able to take a significant withdrawal on the earnings is just for that $10,000 for your first time home purchase, which is still powerful. It's how my wife and I were able to afford our first houses. Was we both had some money in a Roth account, and we both took it, and that helped us out considerably. So teens
I
with
think
go ahead.
I think the biggest benefit here is you're jumpstarting retirement saving. So when your kids get to an age where maybe they're looking at buying a home, to save quite as much for retirement, they can allocate some of those funds to a home or raising kids. So even though you can't directly tap into the Roth IRA, it's freeing up a portion of their income.
Yeah, and anyone can anyone can fund the Roth contribution for the child. So that's a powerful thing too. Like if you don't, if your kid earns $10,000 a year doing whatever, and you don't want them to have to put 3/4 of that money into a retirement account of their own volition, you can do you as the parent can fund or like match a partial funding of that $7,500, as long as it doesn't exceed the contribution limits. So, if you're if you're a parent that wants to squirrel away some money for a child's first home purchase, this is a decent way to accomplish that. Um, you can effectively give your kid tax free $7,500 a year in this retirement account that they can turn around and use. They can take the contribution and $10,000 of the earnings penalty free for a first time home purchase, ostensibly. You see our opening disclosures. Here's a master comparison table. I don't know if we want to like rehash all this. The main point: Trump account and child Roth IRA. These are retirement accounts. Okay, that's how you should be thinking of them. These are things that your time horizon is a minimum of 60 years in the future. When you're trying to plan, give your kid a head start with some like punctuations in between, whether it's first the house, and that sort of thing. 529s are only education. UTMA and UGMAs are generally, we are, upper middle class to high net worth. We have more flexibility. We have more complicated needs, and we're doing some more interesting strategy. Um, do you agree with that kind of general assessment?
Yeah, and I think the overarching point is the reality going forward is there's going to be a huge divide between kids whose parents did these kind of things and didn't. There already is, but I think with more and more people learning about investing, it's going to become more dramatic. And if someone's and set them up with maybe about $100,000 by the time they're 30, there's going to be a huge gap between parents who did that and didn't. And I think probably baseline is going to be kids having around $100,000 by the time they're 30 in these type of accounts. I think that's probably going to become the baseline. And so the big takeaway out of all of this is make sure you're thinking about this and walking away after this and saying, how do I set my kid up effectively so that they can be competitive?
Yeah, absolutely. Um, and then so pause the video here if you want to look at the chart. This is the tax treatment for each of them. Um, again, I don't think we need to rehash this. The key differentiating things, there's the Trump account. Growth is it's a traditional IRA, so it's tax deferred. Contributions are pre-tax money. 529, it's tax deferred and tax free if it's used for education. UGMAs, it's complicated. There's kiddie tax involved, but there's some creative planning happening there. And then a Roth IRA, it is post-tax money so there's no tax deductions for contributing, but all growth is tax-free. This is probably the more exciting part, and this is kind of the thing that I'm hoping perks your attention up a little bit, because we're gonna go through some sims. I've if you are a financial guy, you know what a Monte Carlo sim is. Effectively, what we are doing is we are running numbers based on um, you know standard market conditions. So 9% average growth with 16% volatility. Um, and that's kind of based on the long run S&P 500 performance. We've done each one is done run 20,000 times, and we kind of get a line based on a linear regression based on those lines. And then we're looking at each account's generalized performance. So the and we're also trying to look at the total performance of what is the amount of cash that we have after taxes, after fees, after all of that stuff. So for the first one is um, we're looking at the partial versus full funding of these accounts based on what is the value going to be for a middle class family when the child hits 18. So if you're only partially funding your Trump account each year, and I have the numbers here. Let me. Yeah. So with the $1,500 a year, you're partially funding. You're looking at a mean or a median value of $67,000 at the end of 18 years. For 529, with $5,000 a year, you're looking at 61,000. UTMA's similar; it's $5,000 a year, 57,000, and then a Roth, it's 12,000. But again, remember the Roth assumes that your child is working, so they're probably only contributing between ages 14 and 18 for a child Roth. Um, if you're doing it fully funding, you're dumping some significant coinage into these. 18 after 18 years, you'll have close to between around $200,000. Maximum upward limit is around $400,000, but it's probably going to be closer to two for all of these. So there, Trump accounts, 529s, UTMAs, similar performance. Child IRA would have a similar performance, but you're kind of truncated with your contribution period. Then looking at all tax brackets. So the one that suffers the most from the higher tax bracket is the UTMA, because anything that's in excess of kiddie tax is taxed at the parents' marginal rates. Regardless, the performance is pretty much the same. But what's important to know is like we are the contribution amount is whatever the yearly amounts that we're putting in. The full funding, we're looking at 212, 213,000, 207,000. Like these are large numbers. About 14%. Sorry, trying to follow along with notes and look at the chart at the same time. So UTMAs have a little bit of tax drag, but not much. Each vehicle funded to its realistic ceiling. So these are the values at 18. Obviously, 529 and UTMAs at $19,000 a year, you're gonna beat Trump accounts. So if you're excessively rich and have 20 grand a year to kick around and contribute to your kids, there's probably more efficient ways to do it than a Trump account. Nevertheless, Trump account, $5,000 a year, you're still looking around, a little around $200,000 at the end of 18 years, um, which is very powerful, right? Like this is not, uh, I don't know. Help me out. I'm losing my words, Quant.
So the simple answer is if you're not doing this, your kid's probably not going to be as competitive, because when you're looking at buying a house, you're competing against other buyers that are probably in your age range. And if you have an extra 100 grand of wiggle room, you can afford to give maybe a little bit better on a house and get a house. It gives you more options around career flexibility. It gives you more options on where you live, and not just a house, but location. Maybe you can take a job that pays a little bit less and allows you to spend time with your family. And you don't have to do a whole lot to make it so that your kid has a better life than you did. You probably don't really need to change your lifestyle dramatically.
Yeah. I mean, look, the $5,000 a year in a Trump account equates to $90,000 a year over 18 years, right? And so you are effectively, if you don't do something within the realm of like one of these plans, you know, you are effectively leaving 110, $120,000 just on the table that your kid could use later in life. And that's the big thing is like there are compounding opportunity costs, and this number is only gonna if they do end up indexing the Trump accounts for inflation, it's going to be even more powerful because that means you can put more money in. And so if a $5,000, looking at real numbers, right? So $5,000 per year, you get what, like 21 paychecks per year, in most cases. It's $239 ish per paycheck. If you add in, like, if there's an employee benefit or something, and those employee benefits are probably going to get more popular as more and more people engage with the Trump accounts. But even if they don't, it's still, there's really good reasons to try to make sacrifices in your life, where you can give your kid $240 a paycheck, or $480 a month towards their retirement, their future.
And if
Uh,
you're somewhat financially secure, which you should be before you do this, you're essentially just giving them some of their inheritance early when they can actually use it.
yeah, I mean, like we said, we are talking about somewhere between 5 and 7 on the financial order of operations. So, if you're in a destitute position, you have some bigger priorities to deal with than planning for your kids' retirement. You got to take care of uh, of getting rid of your credit card debt, right? Um, but barring that, at a minimum, you should still open a Trump account, especially if you've had a kid recently or are planning to have a kid in the near future. At least get that $1,000 in, because that $1,000 is still going to be something for them, and that takes no effort. Um, so looking at uh, some interesting things, you can convert a Trump account to a Roth IRA at age 18. The problem is it's going to require a significant amount of effort and like communication to get that done. Um, the Roth conversion is the adult beneficiary, who's now the account owner. So that your child turns 18. They request a Roth conversion through the account custodian. The taxable portion of the converted balance, uh, you know, uh, is included in the beneficiary's gross income for the conversion year. Um, and then there's other esoteric rules, but the bottom line is, if you convert the Trump account to a Roth account, you have to pay the taxes on that, so that it's treated as if you took all of the money out without any penalties and paid tax, and it was normal income, and then you put all the money back and you're paying the taxes on that, which can mean that your child will have 1 year where they're going to need some little side pocket conversations about how mom and dad are going to help them pay their tax bill on that. They're probably still going to be at a lower federal bracket for them, personally. But depending on the size of these, 200, having a year where you take $200,000 as normal income, relative to like whatever else they're earning, in school or in their part-time job, they're still going to probably have a decent sized tax bill there. Which, there's ways to help them with that. What do you think?
Yeah, I mean, ultimately, there's nuance around doing FAFSA for college, for education. So I think just to keep things simple, know that this is an option as you become more financially educated. This is something you should absolutely look into, especially if you are funding a Trump account. But I think for now, it's probably not worth getting too into the weeds.
Yeah. So here, looking at the strategy by age. So at the age of retirement, um, a Trump account kept as a traditional IRA. It's funded through the growth period. So you've contributed $90,000 over 18 years to the Trump account. When they retire, it's going to be worth around $6 million. And with the, depending on market performance, the upper candle on these projections is in excess of 25 million. That's a lottery ticket, but it's within the scope of possibility. Most likely, you're going to be somewhere around, between $5 and $10 million at the end of 65 years, which is like 90K now. $5 to $10 million at retirement. Um, yeah, like you can stonewall about inflation and all that. Still an incredible amount of money, and a significant amount of resources for people in retirement age to be a blessing to your grandkids and to their grandkids and that sort of thing. If you convert to a Roth, obviously the spread is higher, and the median number is higher as well. And again, the difference is any income when they're retired and they're taking distributions out of this traditional IRA pot. Every dollar is taxed at their normal tax rate. So, for a retiree, it's probably going to be like 22%. If it's converted to a Roth, that growth is tax free. They've already paid the taxes on the balance whenever they converted it when they turned 18. So any dollars taken out of this are tax free. Um, the child Roth, uh, it's again, this is truncated because they this is assuming that they only contributed for 4 years between their 14th and 18th birthday. But still, it's the power of compounding, right? You're still looking between, um, you know, $1 and $3 million at the end of 65 years. And then with the 529, the Roth rollover, um, this is a different type of thing, but you can only convert 35,000, which still ends up being, uh, you know, somewhat significant, especially if you roll over into a Roth that is, pre-existing, I guess, and you're adding that to the balance of other retirement accounts. Like I said, this is um, some other stuff. The Coverdell. It's not great, but it is there. Um, it's kind of limited on who can participate, but it's something there to help if you need kind of a tax break, um, and are paying for education expenses. Um, and then if you're real rich and you want to talk about some planning, just do a lifetime descendants trust and set up a trust for your kids and for their lineal descendants, and put it in Delaware and Nevada or Wyoming or somewhere where perpetual, statutes, and hire a corporate trustee and all that stuff. So this is kind of the bottom line of this presentation. I know we kind of got into the weeds a little bit, and we're a little bit all over the place. But the point is to give you a high level overview of what's available for you to do planning for your kids, and how that interacts with your own finances. But also, give you a starting point to start asking questions of your advisors. And if you don't have advisors, find advisors. If you don't want to pay people to be advisors, or you can't afford advisors, talk to the deacons at the church, or talk to someone that you trust in your community. See if your dad or your granddad has a financial advisor that would be willing to meet with you and let you pick his brain about some stuff. Um, but in terms of a decision matrix, so for low income families, and this is basically less than $100,000 ish, uh, as household income. Excuse me. The Trump account, you get the free pilot deposit for any babies. Do it; it's free. And then ongoing contributions. Put as much as you can without taxing your family unnecessarily in other areas, but put it away. And then talk to your kid about the money that you're contributing, what it's there for, what your hope is for how they use it, and make sure that they are financially literate. For middle class, you can blend. So if you are between, let's say, like 100 to 300 to 400,000 household income a year, 529 plan is great for maximizing planning for short-term educational expenses. So within those 18 years, if they're going to have college or private school or homeschool, 529 is a great vehicle to do that. And then layer in the Trump accounts. Um, Basically, it's just low effort retirement income. And then if your kid has a job, or if he's part of your business, or um, they're earning money, um, consider a child Roth IRA, just because they're so powerful. Even if the kid doesn't end up using it to its fullest extent, it is still a powerful training tool to say, like, hey, look how your assets have grown. You put this money in, you're 18 now. Just, this is what you need to be doing. This is being a good steward, and saving your resources, putting them to work in the market. Um, then for high net worth families, do the super funding. You can do UTMAs and UGMAs, um, trusts, Trump accounts. Again, it's still like Trump account is just low effort. It's low effort, no barriers to entry. S&P 500 or US index investments. It's just a good deal, frankly. Um, if you have the scratch to do it. So that is my presentation. I'll go ahead and throw this up. What do you think, Quant? You wanna wrap it up for us? What are your final thoughts here?
Yeah, I would say just get educated, get your situation in order. Once that's done, start building up your kid situation.
So true. So true. You know, get your get yourself in a financial situation. Get yourself stable enough where you can begin thinking and daydreaming and ultimately acting in a way that will give your kids the best chance of success. We're not the baby boomers. We're not interested in dying with and being buried in giant sarcophagi with stacks of cash. Um, we are planners. We're interested in making sure that our kids uh, have enough to get started and that they're savvy and know how to be good stewards of the resources God gives them. So to that end, if you have any questions, leave a comment. Subscribe to Papa Alpaca on Substack and YouTube, and you can follow me on X. Quant is very low key. He doesn't want you to bother him. He's look at him. Look how stressed out he is up there. Look how stressed out. He needs a break. He's gonna go take a little melatonin and take a nap before I whip him back into shape and day trading tomorrow. Um, but for the PacaCast, I'm Papa Alpaca.